Good afternoon. Peter Klein, Chief Investment Officer, co-founder ALINE Wealth, with you this afternoon. It's August. It's summer. I've got no jacket on, so things are weird. But on Wall Street, things are weird too. And let's get to the deck to discuss what we're seeing out there and what many of us are scratching our proverbial heads about. So allow me to share the screen, and off we'll go. Okay. Our first slide today, a macro backdrop, of course, saying with the inflation theme, folks, I don't think this is over. I believe and have said for some time now that inflation is pernicious. It is difficult to vanquish. You usually need a pretty substantial recession to put it back in the bottle, so to speak, but we haven't seen that. We're just the opposite. We're in a very strong wealth effect. And I think only grows the risks of persistent sticky inflation. Not suggesting hyper, simply suggesting that the days of disinflation on the backs of emerging markets, globalization, technology advancements are in the rearview mirror. And I think going forward, I think we're likely to see, largely due to the deglobalization efforts, the decarbonization efforts, and let's not forget that $40 trillion of debt, I think we're likely to see consistent, persistent inflation going forward. And that has implications on how we invest. Here's the U.S. federal net interest costs. This is a tax on the system. The more the government has to spend on interest, the more they can't spend elsewhere, a crowding out effect. So this is important. Of course, it's all been AI. We know that. We know the story with it. It's everywhere and anywhere. Many have said that the entire GDP growth in the last year or so, 2 years, have been AI related. Of course, the CapEx spending by the hyperscalers is expected to reach almost $1 trillion a year or so from now. And these all have implications. What does this mean? And here we have a chart from our friends at the FT that talk about AI-linked tech spending is now a third of U.S. business investment. I'm sure it's a bit more than that when you add on all the other adjacencies to AI. With respect to the hyperscalers, this notion of option adjusted spread on their bonds, they're different companies than they once were. These were companies that were known for its durability, its sustainability with respect to cash flow generation. And today that's not the case because they're spending so much on CapEx for the AI build out. And so the cost of their debt has now inflated, and it's now much a different ball game than it once was. This will be interesting how this works through the next couple of years. Let's keep an eye on that. Of course, as I've said many a time, one of our big concerns with respect to new technology is obsolescence risk. Lest you think differently, our friends in China and India, are certainly trying to win this game just as much as we are. And these are not folks that don't work hard. They do work hard. They study hard. They're technology focused, and they're in many ways even ahead of us in some areas of AI. So we have to make sure to look at that because, of course, any new development in this space can make a big impact to what we've seen thus far. This is the technology game, and this is what you have to deal with when investing in technology. Obsolescence risk is real. Now, the U.S. consumer is also real, but he's really depressed. As you can see here from the consumer sentiment figures from University of Michigan, plumbing new lows here, lower than they were at the depths of COVID. Why are United States consumers so dire? It probably has to do with that K-shaped economy. You've heard of this term, where the top part of the K, the top arm, if you will, are perhaps those folks in the investing class, if you will, folks who have assets that have have enjoyed the growth of those assets, where the bottom leg of the K are folks that perhaps are feeling the pressures of energy costs, of food costs, beef costs, electricity costs. And so we have this tale of two cities here, or two consumers. And I don't know how to square that circle, but I know it's not sustainable nor durable, and it gives me some pause. Okay, that's for the economy. Let's talk about markets. Multiples matter. We've said this before. What I'm trying to show you here is what happens when multiples are extended and what happens the following 10 years. And what you can see when multiples are down here, down this level, high multiples on this at the start, the ensuing 10 years, the forward 10 years are weak. In many cases, in these circled areas, negative. And then, of course, in the green box up top on the left is when you see low multiples on the start, and then the following 10 years, obviously, you're seeing stronger growth indicated in that box and the dots in there. So what this takeaway is that, sure, you may not notice it right away, but historically high multiples lead to less forward growth. And I think that is important when we're thinking about wealth building and wealth accumulation and the magic of compounding. You know our job. We're not here as a gunslinger or a prognosticator of markets per se. We're here to make sure our clients compound wealth over time. And to do that, you need to avoid losses and you need to avoid pitfalls. And we do that by being mindful of what we pay when we enter an investment. Similarly, here, we're talking about multiples in the S&P. These are trailing PE ratios broke down by the inflation tranche. And so, again, if we're thinking of an inflation tranche in the 4% range, where we are now in some cases, you could see what a typical PE multiple would have been prior to 2007, the great financial crisis, when we've got QE and when the Fed balance sheet zoomed higher and this new era of financial engineering came into play. A pedestrian 15 times or even 18 times pales in comparison to where we are today at 20 something times earnings. It definitely is something we need to keep an eye on. Now, when we're looking at markets, we always look at sentiment. We look at what the people are doing. Remember, more buying will more likely raise prices. So we have to realize what's going on in the actual market, what's happening with the investors, what's their mentality, how they feel about risk. These sentiment indices are important to be able to look at that. And here we see a pretty substantial exposure or growth rather in the last few years on the use of margin. Many folks do this for a tax strategy rather than selling their shares. They borrow against them. Many do it just because they want to buy more shares. This is a yellow light of caution, folks. When we've seen this in the past, markets react negatively. So let's keep this in the forefront of our thinking. Now, there are some good news that we find as well. We're always looking for good areas to invest our clients' assets in and to grow them, but we want to look to do so with a strong margin of safety. In this chart, I love this chart because I'm a unabashed value investor. What we're looking at is how the lowest tranche of PE ratios, ergo value investing, did every 5 years, rolling 5 years. And you could see there's barely a negative number here. The numbers are fairly substantial you could see a lot of strong double digits. And we're buying companies with low PEs. So by definition, we're buying companies that have a strong margin of safety because you're not paying high for them. And I think that The fact of the matter is that has led to consistent growth and compounding of wealth over time. So I asked you to think about this notion of getting wealthy slowly. When Bezos asked Buffett why people don't do his kind of value style investing, Buffett came back to him and said, because people don't like to get rich slowly. And that's the fact. Everybody wants the lotto ticket. Everybody wants to have a big win. Everybody wants a shortcut, an easy way. In this case, maybe the better way is to be patient and compound and grow and don't lose. Boring. Here's another example of boring. Dividend growth. Boring has beaten exciting over 26 years. NASDAQ versus Dividend Achievers Index. The Dividend Achievers Index is a grouping of compass stocks that have increased their dividend, increased the dollar amount of their dividend for 20 years consecutively. In some cases, it's been as long as 30 years. And these companies are consistently beating increasing their dividend rate. And that's not easy to do. There's only, I'm not going to say a handful, but there's probably 30, 40, 50 companies that fit the bill. Dividend Achievers Index, done very well. Not exciting, not going to go up dramatically, steady Eddie, keeps on going. Okay, just to remind you our current thinking, what we're overweighting. We do like life sciences and biotech. Dividend growth, the water sector, of course, value style, but we're underweighting large cap growth, pre-revenue companies. I don't even consider those investable in many cases, although they certainly have a lot of revenue, a lot of market cap these days, and anything to do with financial engineering as per our feeling about interest rates and inflation. So that's where we're at. We thank you for your attention. Look forward to further discussions. If you have any questions about what we do at ALINE Wealth, how we serve our clients, how we manage and balance the duality of our mission, the one end, making our clients money, growing their assets, capital appreciation, income growth. On the other hand, protecting, caring, worrying, making sure they're always in the front of our minds. That's the duality of our mission. That's ALINE Wealth. Have a great summer, guys.